Good afternoon, ladies and gentlemen. Welcome to the JKH Investor Relations webinar for Q3 22-23. I am Gihan Kure, the Deputy Chairperson and Group Finance Director. I am joined by Krishan Balendra, the Chairperson CEO, for today's webinar. The format for today's proceedings will be that Krishan will initially walk us through an overview of the performance and an overview of the macro environment in the country. And then I will take you through a presentation of the performance for Q3 and some of the key features of our performance for this quarter. We will then open up for a Q&A session. If you have any questions, please do enter it into the Q&A tab at the bottom of your screen. With that, I'd like to hand over proceedings to Krishan to start off with an overview. Thank you.
Good afternoon. I'll begin with, for those of you who are based overseas, with an update on the situation on the ground. Since the events of mid-2022, we have seen a significant improvement. We are no longer seeing queues or shortages of petrol or diesel or fuel. We are not seeing long power cuts. There are power cuts, but of about 2 hours in duration. We are not seeing gas shortages, and generally the situation on the ground is normal. Traffic in the city for sure is back to what it was. So that extreme situation that we underwent mid last year with the shortage of Forex is no longer the situation on the ground today. We have seen the country's Forex reserves improving marginally, availability of foreign exchange in the banks improving, remittances having dropped sharply. Each month is now better and improving. Consumption, as you would have seen in our numbers as well, and Gihan will go into more detail, consumption has fallen with the very high inflation that we have had, as well as the higher taxes. Tourism is getting better. With all the bad publicity that we had mid last year, we saw tourism numbers fall sharply. But since October, there has been a gradual improvement. It's taken a little longer than we expected. However, in the month of December and in January, we have seen a sharp jump in arrivals. In January, the country saw about 102,000 tourist arrivals, which is still well below pre-pandemic, but significantly better than what we saw most of last year. The outlook for tourism is also improving. We can see that from our forward bookings. In the month of January, we had approximately 50% occupancy in our Sri Lanka resorts. We are expecting that to be over 60% in February based on the current momentum. So encouraging signs that tourism is getting better, and also now with the opening of China and Sri Lanka being designated as among 20 countries open for travel by the Chinese government, we think as the flights return, that numbers from China will also improve. On our large projects, the Cinnamon Life project is continuing to progress well. As you know, the 2 apartment projects and the office tower have been completed. Tenants and buyers are in the process of moving in. The hotel and the mall also construction and fit out is progressing very well. The facade is now completed. Some number of the rooms have also, the fit outs have also been almost fully completed, and we are looking at opening the hotel and the gaming in one go in the first quarter, in the June quarter of next year. We are currently engaging with potential gaming operators and gaming experts, and we expect to be able to communicate a way forward for the casino in the next few months. As you know, the regulations for gaming were gazetted in September last year, and they were passed in Parliament in December last year. That was a couple of months back. West Terminal also progressing very well. The dredging work and reclamation of the quay is on schedule. About 50% of the reclamation for phase 1 has been completed already, and full completion will be over the next couple of months. And so far, despite some of the escalations in construction costs, material costs that we saw early last year, from what has been contracted and finalized up to date, the construction costs are within budget. The government has also announced that they are looking at certain privatizations. We will monitor progress on that front and look at opportunities that are a fit with our core businesses. So that was a quick high-level update. I'll hand over to Gihan to run through the quarter results.
Thank you, Krishan. So I will take you through the presentation, and it's the standard sort of presentation that we go through. Looking at the performance for the third quarter for December, the group did an EBITDA of 10.4 billion, as you can see under the Q3 column, with some of our businesses recording gains, but we did have certain challenges during the quarter, particularly with our consumer foods business, as you can see, and we'll talk a little bit more about that. But our transportation business, retail, leisure, all were up, including then financial services and some of our other businesses, including the IT and plantations business. Group EBITDA grew 9% for the quarter, as you can see, but I must highlight that there was a one-off deferred tax impact on our ports business at SAGT, which resulted in an impact of around 750 million rupees, roughly, which did drag down the performance of the transportation business. Now, whilst this is an EBITDA number, because SAGT is an associate company, an equity accounted investee, we consolidate our share of PAT, and therefore the deferred tax impact is actually reflected, even though we are talking of this from a group context in terms of an EBITDA number. Had it not been for that one-off impact, then group EBITDA grew 17% to 11.1 billion rupees. Just looking at the cumulative performance for the 9 months, the group has done an EBITDA of 33 billion rupees compared to 20 billion rupees in the same period of 9 months for the last year. To put that into context, the annual EBITDA for last year, 21-22, was at 39 billion rupees. So in terms of the current momentum, we are seeing we've already done 33 billion for the 9 months, which shows that the momentum of recovery that we saw post the pandemic has continued, but while some of the businesses are seeing some challenges. Looking at the quarter-on-quarter performance, at a headline, again, we've seen the Q3 performance growing against Q2. There is, of course, some level of seasonality as you look through the different columns. And of course, when you compare it against last year Q3, there is a significant impact because we did have revenue recognition and some profit recognition in Q3 in Cinnamon Life. So the last line that you see on this slide eliminates that impact. But if you look through each of the businesses, you see that transportation is down due to the reason that I mentioned. If you look at it on a quarter-on-quarter basis, largely due to the reason that I mentioned on SAGT, but we did have some impact on our bunkering business, which I'll talk to you later when we come to transportation. Consumer, we did see that impact, which we will again talk through, but some of the other businesses have seen a sort of positive turnaround, and that is what has contributed to still a fairly strong performance for the quarter. I'll spend a couple of minutes on this particular slide. Is if you look at it from EBITDA to PBT, we can still see there's an impact, as we discussed even in the last quarter, with the finance costs that are coming through, and that translates to an impact on PBT. So if you start with the far right columns, you see the PBT impact, and we've shown you Q3 last year as a comparative, but also shown you last quarter what we did in Q2. So if you look at it against last year, there's a significant decline in the PBT, and there are some reasons which I'll go through. But if you look at it against Q2, we are seeing a better PBT despite the finance costs. If you move to the other columns on the left, you'll see Q2 to Q3, the finance cost has increased by around 1.5 billion rupees, but despite that, the PBT has still been better. Again, here you see the impact on property from last year to this year, where the revenue recognition and profits are there. But if you walk through some of these numbers, you see particularly with retail, there's a significant increase in the finance cost, leisure as well, and consumer foods off a lower base, but again, a fairly significant increase. So as we explained even during the last webinar, with some of the disruptions and supply chain challenges that we faced and the country faced, we did invest in stocking up on working capital, on inventory, just to ensure that we could manage and navigate the disruptions that we expected or everyone anticipated. Fortunately, the country didn't go through the disruptions to the extent that it could have or may have transpired. So that was certainly a positive. But what that did mean is that we did have to invest in that working capital, and with interest rates at the margin being close to 30%, that naturally translated to a negative impact on our finance costs. Now, as we go forward, we expect that additional investment in working capital to continue to come down. We are already starting to see that. So even if the rates remain at these levels, we will see that benefit coming through, where the finance cost of the group will start coming down. As we explained the last quarter, the last bullet point on the slide that you see there is the notional interest costs that coming through on the P&L due to the convertible debentures. In the last quarter, the impact was roughly half of this, because we had that impact only coming from around mid-August onwards, whereas this quarter we have the full impact. So there's 3 months of that impact, which is around 700 million, which is a charge to the P&L in terms of a finance cost, but it's a non-cash notional charge. So in reality, that number could be looked at as a lower than by 700 million rupees. Moving on to some of the balance sheet numbers, our net debt excluding leases is at around 130 billion rupees, up from 117 billion rupees. And of course, this number will gradually increase as we infuse funds into Cinnamon Life as the project reaches completion. So if you look at it from a net debt to equity basis, excluding leases, we're at around 35%, and that is a comfortable number. In terms of our run rate on EBITDA, as I explained to you earlier, on a YTD basis, we are at 33 billion rupees, and last year we were at 39 billion. So if you look at it just as a debt to EBITDA number, just taking last year's number as a base, and it certainly seems that we are on track to get there or better that, then you're looking at around 3.5 times debt to EBITDA, which is still, we believe, a comfortable level in terms of a net debt to EBITDA. In terms of some of our ESG initiatives, I won't go through all the numbers here, but we've seen improvements on our carbon footprint as well as water withdrawal in terms of our efficiency. So we've seen declines in the right direction. Under our One JKH initiative, we've done a lot of other work and we've made good progress. One of the new areas we've also looked at was to look at surveys to understand opportunities to give career opportunities for persons with disabilities, and that's something we are adopting and looking at rolling out across the group, and we brought in policies to that effect as well. We also undertook a lot of initiatives to support our fellow citizens through these times of difficulty, and through the foundation and our various businesses, we've had various crisis response initiatives focusing mainly on food, nutrition, and education as well for vulnerable communities. Moving on to our businesses, moving on to the transportation group, overall port volumes for the quarter did decline marginally right across. And if you look at SAGT, it was a similar sort of decline, and I'll go through the numbers. Krishan spoke earlier about the progress on the West Container Terminal. So if you look at the pictures on the picture on the image on the left, that's the breakwater and the area demarcated for the WCT1 terminal. On the right, you see the images with the dredging progressing very well. We've made significant progress where a lot of the dredging work, or more than half of it, is sort of now getting completed, and that work is progressing well. Moving on to the numbers on SAGT, as I said, we've seen a slight decline in volumes in line with what the market has seen, and some level of softness in regional trade. So it's not that Sri Lanka has lost out, but we've seen some slowdown in regional trade as well, which is what is reflected here. But that's not something we expect to continue to see declining too much. We've seen the domestic to transshipment mix at SAGT improve slightly, and overall, along with ancillary revenues and the benefit of the translation, we've still seen a strong performance. And again, just to remind you, had it not been for the one-off impact on the deferred tax, the EBITDA performance was very strong, where the transportation group did about 2.2 billion of EBITDA for the quarter. LMS did see an impact on profitability in Q3, largely because of the steep decline in fuel oil prices in the month of December. So October, November, we were fine, but just because of that sharp decline just in the month of December, there was an impact. Volumes for the quarter did fall around 8%, which is in line with the market. But the main reason for the decline in profitability was that impact, which of course now we're seeing more stable oil prices, so we don't expect that to continue. Moving on to our consumer foods business, and this is one of the businesses we've seen a fair amount of challenges during the quarter. We saw volumes decline across the three main categories. So the ice creams and soft drinks businesses declined by 19% each, and our processed meats business declined around 33%. Now, whilst we did see growth in ice creams and beverages in Q2, in Q3 we've seen this impact given that the prices have been increased, and how much of sort of we are starting to see that impact on the elasticity of demand with these price increases now being sort of fully implemented in the market. We also did have some impact where, if you look at Q3 last year, was a very strong year. You can see the type of growth that we showed last year as we got out of some of the lockdowns. So there was a lot of pent-up demand. So the base is a little bit higher, but we are also starting to see the impact on consumer spend and sentiment, which is what we are seeing. Now, if you look at it on a month-on-month basis and the momentum, October and November saw lower declines, but December, which is typically a sort of more of a peak month, we saw a sharper decline, and we are seeing that sort of trend continuing through January. But it's something we'll need to monitor and see, particularly with the tax increases also coming into play. But that's of course at a higher income bracket. So we're not sure whether that will have a significant impact in this segment. But naturally, overall sentiment is a little more dampened than we saw in Q2. Now, that naturally did translate to a significant impact on EBITDA margins with the volume decline. But apart from that, we did speak of the margin compression due to cost increases that we were seeing, as we discussed in Q2 as well. And I'll take you through that in the next slide. I spoke of the margin pressures earlier as well, when I was talking of it in the context of an overview, where the group did invest in buying materials ahead of time and so on. And with the foreign exchange liquidity or lack thereof, we also had to commit to buying materials forward. So all that sort of did translate to higher costs. And as we showed in Q2, apart from that, with global commodity prices also going up, we did see an impact. Now, if you look at the chart on the right, you see sugar prices have sort of continued to increase Q2 to Q3, and this is largely because of that forward buying impact where we did secure some materials. But as we head into Q4, as we did indicate even the last time around, we expect to start seeing a reduction in these prices, and therefore, all other things being equal, margins to start getting better. Now, if you look at some of the other cost items, we are just showing sugar, and in beverages in particular, because this is a different category of sugar, it's a more refined sugar, we did buy forward, and that's why you're seeing this. Now, if you look at it in ice creams, it's a different type of sugar, and there we've actually already started seeing the reduction because the level of stocking up also wasn't as much as we did with beverages. So you're starting to see that coming off. Even skim milk powders, from the peak, it sort of has plateaued, and now we're starting to see in the month of January onwards, these prices have now started coming off. In terms of energy costs for this business, it's not as significant. You can see the type of energy cost impact, but with the revised tariffs, we've seen some impact. But I think the bigger issue is the raw material costs, which we're hopefully seeing that reversal of that trend. Now, with volumes, of course, falling at 19%, the ultimate impact on net margins will depend on where volumes also settle. But overall, on a product-wise, gross profitability basis, we are expecting to see improvement from Q4 onwards. Moving on to our retail business, this business has remained quite resilient. So if you look at Q2 to Q3, we've seen overall EBITDA in this business growing, mainly with the supermarket business growing. Our office automation business actually did see a decline with some of the import controls that have been there. So the mobile phones business and some of the other areas haven't seen the same level of volumes and profitability that we saw last year. But if you look at the supermarket business alone, you can see a strong sort of recovery. If you look at Q3 last year to this year, we've seen strong growth in EBITDA, and even against Q2 to Q3, there is of course some level of seasonality, but still we're seeing that sort of run rate improvement, and EBITDA margins at 7.7, which is quite healthy. We've still seen some pressure on margins here with the price increases and so on. So we've seen a slight compression of GPs, which we expect to improve, as well as with some of the efficiencies we are looking at, as well as depletion of some of the inventory that we had purchased, which was at a slightly higher price. We expect, all other things equal, margins to recover. We've seen our same-store sales growing, driven by footfall, mainly, of course, ABV, supported by price increases. But if you look at inflation being at close to 59%, we've seen ABV grow at 26%. So the full impact of inflation hasn't come through ABV, because we've seen consumers also change their behaviors, and what we call the weight of purchase, or the number of units purchased in a basket, has adjusted to some extent. But overall, net, we are still seeing 26% growth in ABV and 11% footfall growth, which is also quite significant. And that trend that we've seen in terms of footfall growth, conversion from modern trade, we've seen that continuing, which has supported overall same-store sales growth of around 40%. Moving on to our leisure business, for the calendar year 2022, Sri Lanka ended up at just over 700,000 arrivals, which is a strong recovery, of course, against the very low base of 2021, but not really in line with expectations or what should have been sort of a post-pandemic recovery, due to some of the socio-economic issues that the country faced. We still should have seen a faster recovery, given that the ground situation from around August onwards has been very much normal, particularly for a tourist coming into the country. but the negative sort of perception and lack of awareness of the ground situation didn't support a stronger recovery. We've still seen a recovery. So if you look through from September, October, from 40,000 to 60 to 90,000, we've seen that momentum heading in the right direction. And for the month of January, we did just over 100,000. So month on month, we are seeing that improvement, but it's not been as promising or as strong as we would have expected. But we are starting to see a positive trend in terms of forward bookings, inquiries from some of the traditional markets as well. And from around July onwards, we expect that momentum to really pick up and hopefully reach pre-pandemic levels of numbers. This is something where we do get questions just about connectivity into Sri Lanka. So as the world comes out of the pandemic and global travel returns to normalcy. So what's encouraging is that despite all the setbacks, we've seen air connectivity into Sri Lanka come back to pretty much pre-pandemic levels. So this is just a quick snapshot. Some of these numbers may change, but the main airline, of course, the national airline, Sri Lankan Airlines, is actually higher than the pre-pandemic levels of frequencies per week. And some of the other key airlines that offer connectivity into the country as well have recovered. And there are other airlines also starting frequencies, which is again quite encouraging. Moving on to the Maldives, again, the momentum, of course, has been quite strong throughout the year. So 2021 was also a fairly strong year, but if you look at 2022, it's almost at pre-pandemic level numbers, and that momentum has been good, and we've seen that translate to better occupancy for our properties as well. Here you can see how Sri Lanka as well as all our resorts have sort of now recovered in terms of momentum in Q3. Just looking through the numbers, in the Colombo hotels, we did see an increase in occupancy, a marginal increase, a slight reduction in ARRs, but overall EBITDA margins in line with Q3. Sri Lankan resorts, again, we didn't have much foreign arrivals, so whilst occupancy was slightly better than last year, we did see a reduction in ARRs because the domestic traveler, whilst prices have increased, it hasn't fully adjusted on a dollar basis. But once we get more foreign arrivals coming in, then naturally the dollar ARR should start recovering by and large in line with what we've seen before. In the Maldives, occupancy was slightly better than last year at the same period, and more importantly, ARRs have also recovered. We did see EBITDA margins coming off despite that, from 37 to 31. And one of the reasons is we've seen some staff cost increases right across, not just for us, but mandated minimum wages and so on, which did have an impact. But more than that, the Maldives did have a significant impact on the fuel. So given that all the power generation is essentially diesel fuel, we saw prices increase, and those prices, whilst global prices have come off, we haven't seen those prices across the country coming down as much, but we're starting to see that. So that aspect of it in terms of the negative impact on EBITDA should start reversing and correcting and get better. So overall, with all this, we've seen a strong sort of rebound against last year with around a 50% growth in EBITDA in the leisure business. In property, we didn't have any new sales or recognition on Cinnamon Life given the current environment, and as we had indicated earlier, we expect to start seeing a pickup once there's greater clarity and announcements on the gaming and as we get close to completion on the entirety of the project. We had also announced, and I just touched very briefly on this through the chairperson's message, we had indicated the timelines for when we would expect to be operational, as Krishan also spoke earlier. We are looking to align the timing of our opening of the gaming space together with the hotel to optimize the impact of an integrated offering of this nature. In terms of the project costs, given some of these impacts on the delays due to the current environment in the country, as well as, of course, as we get into the finishing fit outs and so on, we've seen about a 10% impact on the project cost. Now, in terms of what we've disclosed before and how much more there is to completion, it does not mean that this amount is over and above that. So we are looking at still around $125 million more to go in terms of project cost, because some of this increase was already sort of factored in terms of our expectations. This is just a image of what Cinnamon Life is right now under construction, but from what was originally shown in terms of a sketch and the rendering. But I think this is quite an interesting image in terms of a rendering of what Cinnamon Life was expected to be and what the actual look of Cinnamon Life is as of January 2023. So it's sort of pretty much identical to what that rendering is. I think you all have all gone through the different components of the project. I think in this slide, we've given a little more color or detail into the different conferencing spaces and so on, which I won't go through, but it's available for anyone to go through the detailed slides. Lastly, on financial services, we saw strong performance for the quarter, mainly driven by our insurance business, but also with the bank. The insurance business did record a higher surplus in Q3, and that's been the main contributor to the better performance. But also we saw improvements in GWP, as well as some benefit coming through with the higher interest rates, which helped drive higher interest income in the insurance business. In the bank, we've seen fairly strong performance in terms of NIMs being quite robust throughout. This, of course, is still the Q2 number we are talking of, because the financials are yet to be released, given that they're December companies. We've seen, in line with industry, NPLs being challenged, and that's been similar across the industry, where we're seeing an increase. But overall, there is a focus on collections, and the overall profitability of the bank has remained quite resilient despite all the headwinds. So that brings us to the end of the presentation part of today's proceedings. I will open up for Q&A. Again, I just like to invite you to pose any questions on the Q&A tab at the bottom of your screen, should you have any questions. Krishan, just to start off with local government elections expected in March, I think there was a question about what sort of impact, if any, we could see on the current sort of macroeconomic stability and business situation on the ground.
Yeah, we don't expect any impact. I think after the events of last year, the whole country has learned a lesson, and I think we all appreciate how important it is now to get the economy back on track. Tourism is growing, not yet back to normal, but I think from our engagement directly and through the Chamber of Commerce with the main political parties, I think we are confident that there will not be disruption before or after the local government elections.
Thanks, Krishan. With the West Container Terminal and some of the developments or news on the Adani Group, I think there's a question in terms of whether there would be any impact on the current momentum.
No, we don't expect any impact. As I said, the construction is on schedule, in fact, a little ahead of schedule. The developments which have been in the media, as the Adani Group have said, none of their projects, ongoing projects, will be impacted. The first phase of the project is expected to be completed end of 2024, calendar year 2024, and it's very much on schedule. Full completion will be end of calendar year 2025, and we don't expect any impact from these developments.
Krishan, you already spoke about Cinnamon Life, but I think maybe if we can elaborate a little bit more about the arrangements on the gaming, as
Yeah.
well as a little more color on the timing of the opening?
Yes. So the regulations were gazetted in September. It was only when the final regulations were gazetted that we could meaningfully engage with the potential operators and gaming experts in the region. And we've been doing that since, and we have now shortlisted about 4 parties. We are keen, given the scale of this project. It's an investment of about $1 billion. It's an iconic project comparable to the best integrated resorts in Asia. So we don't want to rush into appointing a operator. We want to make sure we get the best possible operator who can have the best impact in this part of the region. So we expect that we will finalize a party over the next few months. And from our discussions with the potential parties, the fit out could take and the equipping could take about 12 months. So, as I said, we are looking at opening the entire hotel and the casino in the June quarter of 2024.
There's a question on whether the bulk and impulse ice creams volume saw decline by similar amounts. I think overall, by and large, yes, but I think we saw greater decline with the bulk ice cream segment, and impulse has been a little more resilient in terms of volumes. There's a question on the forward bookings for city hotels in February so far, and the level of occupancy witnessed in January. Krishan, if I can
In
ask.
January, occupancy in the city as well, similar to the resorts, was 50%. And based on the current momentum, we expect occupancy of about 60% in February in the city.
There's another question on whether there'll be a capital raising in the hotel sector to reduce leverage. I think we've spoken before about how we look at the whole hotel sector and the consolidation, and the fact that our balance sheet is quite skewed with exposure onto the leisure sector, and that's something we've been working on. But Krishan, is there anything else you'd like to
Just to say, it's not really about reducing leverage, but it's about realigning the overall portfolio so that, in particular with Cinnamon Life, we are not too heavily skewed towards real estate and hotels. So, real estate and hotels, by their very nature, have more modest returns on capital compared to some of the other sectors. So we are looking at having a slightly more asset-light exposure to hotels.
There's a question on whether the notional non-interest interest cost of 700 million will reduce if market interest rates reduce, because that is computed on the basis of the interest rate we pay, which is the 3%, and what was the expected interest rate at the time. So you benchmark it at that point, and then this is computed on that basis. So once that is computed, then that amount is what you charge to the P&L. So that does not change even if market interest rates fall, or if it does go up even further. There's also a question on the operating expenses at CCS, Ceylon Cold Stores, for the quarter, and there was a significant increase compared to the last year. I think this is the social security contribution, the levy that comes in. So it is a top line tax which wasn't there earlier. So that 2.5%, particularly in our retail business, which is quite significant, is what has sort of impacted the operating expenses, because that's reflected under that line item. There's a question on the footfall conversion. I think I already covered it, but just in case, we've seen footfall grow for the quarter at 11%. So that conversion that we saw, or that momentum, seems to be continuing. At least up to Q3, we've seen that benefit. There's a question on how we plan to fund the, I'm not sure whether this number is right, but it says the 1 billion for the gaming segment. That is not the investment for the gaming component anyway. The total Cinnamon Life project cost is at 1 billion, and like I alluded to earlier, we have roughly another $125 million more to go in terms of our commitment. Now, the gaming space itself, as we've said before, it will be a arrangement where Cinnamon Life is the landlord, and we will rent out the space. There will be an operator or someone coming to operate that space, and a party fitting out the space. So the fit out investment on the gaming equipment and so on would be done by that particular party and not undertaken by JKH. But that investment for a gaming space would be nowhere near this sort of sum. It's a much smaller amount to fit out a gaming space. But as I mentioned, just to reiterate, that would be not something that JKH has to commit to that investment. Krishan, there's a question on whether Cinnamon Life will be listed, but also more than that, I think in terms of the interest on the office towers, the floors there.
We don't have a specific plan to list Cinnamon Life at the moment. But if depending on the environment, we may look at it. It's not something that I would say a firm no to, but there is no specific plan at the moment. The office tower, of the 24 floors, 4 floors we have sold already. 10 floors are occupied by HCL, and of the remaining 10 floors, we have some fairly advanced interest for a few floors, for 3 or 4 floors at the moment, to purchase. So while our original plan was to retain 14 of the 24 floors and sell 10, we have sold 4 so far. So depending on the interest, we will look to sell more floors.
Thank you. There was a question on whether which segment we plan to include Cinnamon Life under when we report it. So given that it's an integrated resort and under the mainly a hotel operation with conferencing and so on, it will be reported under our leisure segment. There was a question on the staffing requirement for Cinnamon Life. Krishan, any comments on that? I know in terms of efficiency, we are looking at something more efficient than our current numbers.
But we are looking at something more efficient. But given the multiple ballrooms, there are 4 ballrooms in the complex, and it was designed for that purpose, to cater to large events, regional weddings and events. So we are expecting that it would have about a staff ratio of about 2 per room. So about 1,600 staff.
Given the current environment, how will profit be generated to utilize the tax losses in the hotel sector? So I believe this is about the deferred tax asset that's there, and we have a deferred tax asset given the losses, and that recovery, there's a certain time period, and based on the type of recovery and the outlook that we are seeing, we expect that certainly that those tax asset, that it can be recovered, and that's something that anyway is discussed and agreed with the auditors as well. There was a question on just the momentum, which I believe I covered, but the momentum on the volumes that we are seeing in CCS in Jan. So as I explained earlier, for anyone who may have missed it, so despite though we saw a 19% decline in volumes for the quarter, we saw October and November didn't see that pace of decline. And of course, December, which is a peak month as well, saw a greater decline. So it sort of averaged at 19%. But in terms of the current run rate, the decline is slightly higher. But we'll need to see where it settles. there were some disruptions in the market as well with the weather and so on. So it's not to say that that alone contributed to things, but we'll need to see. But in terms of the current momentum, it is slightly higher than the 19% average that we saw for the quarter. So that is what we've seen in January as well. In terms of the EBIT margin outlook for CCS going forward, and the volume decline, we can't sort of give a forward prediction on margins. But as I did touch on earlier, we are expecting to see gross profits increasing on a product basis. But again, it depends on what type of declines we end up seeing. And naturally, with that type of decline, you do have an impact on operating leverage. So whether that erodes the margin gains that we have or not is something we'll need to see depending on where it settles. But unfortunately, I can't sort of give any more color or guidance in terms of where we expect margins to be. There's a question, Krishan, on, I think we did sort of cover this but by Jan, are we meeting the April forward booking expectations you had as of December? So I think it's sort of looking at where we are now, given where we were expecting things in December.
No, I think it's a little better than what we were expecting in December, because in December the traction was still quite slow. But over the last few weeks, we have seen forward bookings with each month, each week, getting better than the previous week. And now with China opening as well, we think certainly that April will be better than what we were expecting, in 1 month ago in December.
There's a question on the consumer foods business, whether we can expect the pace of price growth to taper down going forward. Now, if you look at it on a quarter-to-quarter basis, yes, it would taper down because the pace would reduce in terms of price increases. But if you still compare it on a year-on-year basis, you still see the price increase impact coming through. But naturally, it will taper down unless there are further price increases, which if with the current trend, we don't expect to see too much more price adjustments unless there are other events that warrant further increases. I may not be able to get into the specifics on this question, but whether Union Assurance and NTB have shifted their bond investments to longer maturities to benefit from a possible decrease in bond yields after an IMF deal is inked. Now here it varies, because I think if you look at the insurance fund, yes, we have been locking in for the longer term, but also at the same time, one needs to be conscious of the impact of a possible DDR or what form or shape it could take. So even with the bank, it's then a question of what type of impact it could have on capital if you sort of go in. So if you look at the rate on a standalone basis, yes, it is attractive as a long-term rate, but then depending on, like I said, the form or shape that a DDR could take place, then you could see impacts on sort of mark to market. So therefore, it's something that is being managed within those sort of risk appetites and tolerance limits. There's a question, Krishan, on whether the group will look at any acquisitions in other sectors such as healthcare or transition the food segment gradually to exports.
Yeah, we are not actively looking for acquisitions or investments outside our core sectors. Of course, if there is something very attractive, we may look at it. In the food segment, we do have some small volumes of exports to the Maldives and Australia and to Europe, but nothing very material. We have been actively looking at enhancing our export volumes over the last year or so, but immediate outlook, I can't see a material change. So,
thanks. There's a question on why the ADB options didn't get exercised, and whether in that context, whether there's a risk of that happening with other investors. I'm not sure. That may not be as relevant because ADB had an option, and we don't have any other sort of options to get expired other than, of course, the debenture, the convertible debenture, but that's already, we've received the funds. The ADB option didn't get exercised. The floor price on that option was at 165 rupees, and given the market conditions and the rate at which the share was then, that didn't get exercised. There's a question on the progress on the NTB stake or the dilution. We had written to the central bank requesting for an extension of the time period, given the current environment, and particularly in the context of the banking sector facing significant headwinds, the type of capital requirements that are required of banks. Not that I'm saying NTB needs that, but all the banks are trying to show up capital. So I think it's a time when all the banks need strong shareholders, and given the current market conditions as well, we've asked for that extension. So right now there's nothing required to be done on that. Krishan, there's a question on the mention of privatizations in the quarterly commentary in the chairperson's message, whether JKH is in the final stages of any takeovers, but that's the question. No, so that was more in the context of macro commentary in terms of the government's own reforms and what should be done. So maybe we can clarify
I think
that.
as you would know, there is nothing specific. While the government has said that they will look at privatizations, and SOE, I think a reform committee has been appointed. They haven't come out with any specific privatizations. So certainly we are not on the brink of any acquisitions. So.
There's a question on the current progress on the store openings for 4Q. So we had opened one store. As we had indicated earlier, we are sort of taking the store expansion a little slow, given the environment, the interest cost, as well as the construction cost significant increases that we saw over the last 2 quarters or so. From a medium to long term perspective, we still see the opportunities. I mean, we spoke earlier of the growth in footfall, so that conversion from general trade to modern trade, all that we see as a positive. But it's just that in terms of the current capex and the cost of work investment, we are just evaluating it very critically. Doesn't mean we've stopped our expansion, but we will continue to look at it, but look at it critically as we go along. There's a question in terms of percentage completion point of view, how far along Trizen is now. So we are at around 75% sold, but in terms of revenue recognition or completion, it's not as high as that. It's over 50%. But we will be recognizing revenue in Q4 as well. And of course, with Trizen, it's an ongoing recognition. We are starting to see inquiries and traction on new sales inquiries as well. So there are leads. Whilst we didn't see much sales in the last 2 quarters, it is encouraging to see new leads coming through. And we hopefully will expect to start converting these in the next quarter or 2 onwards. And progress on Trizen, of course, is such that we're expecting completion by the end of this calendar year, and for us to be able to start handing over units thereafter from Q1 next year onwards, Q1 calendar year. I do not have any other questions in the chat box. If there are any final questions that anyone wishes to ask, I'm happy to take it. Any questions? We are almost out of time, so maybe I'll just leave it 30 seconds to see if there are any questions that come up. No, there are no further questions. So I'd like to thank you very much for taking the time to join our Q3 webinar. The recording of this webinar will be uploaded on our social media platforms. So for anyone who wishes to go through it again, it will be available. So thank you very much once again, and good evening to you all. Thank you.